Good morning. Today, our team will be delving into the world of risk management as it relates to Robinhood Incorporated. In this presentation, we will explain the results of a detailed risk assessment for Robinhood Incorporated's portfolio. By understanding the risks inherent in Robinhood's business, we can make informed decisions and enhance the company's overall resilience. Robinhood is a commission-free investment platform that offers a wide range of assets, including equities, options, cryptocurrencies, and ETFs. Known for its user-friendly interface and accessibility, Robinhood has gained significant popularity among investors of all levels. The purpose of this analysis is to assess the risk profile of Robinhood's diverse portfolio. So we will calculate the value at risk and expected shortfall to quantify potential losses. Additionally, we will identify key risk factors and develop an effective risk management strategy. Ultimately, the analysis aims to provide valuable insights for investors and stakeholders. Now that we have a clear understanding of Robinhood's portfolio, let's discuss the data collection process we followed. To assess the risk profile of Robinhood's investments, we gather data from multiple sources. Firstly, we obtain information from Robinhood's 10K form, which is basically a comprehensive financial report that provides details about the company's investments. We utilize Capital IQ and Yahoo Finance, which are leading financial databases, to assess the information. And then we collected 3 years of historical data for each asset class, including cryptocurrency, loans, fixed income securities, and derivatives. And this information, again, was sourced from Capital IQ and Yahoo Finance. We then exported the data and cleaned it in Microsoft Excel, where we calculated the value at risk and expected shortfall. So now let's delve into the specific methodologies we employed. We employed a combination of statistical techniques to calculate the value at risk and expected shortfall. The value at risk measures the maximum potential loss over a period of time at a given confidence level. The expected shortfall, on the other hand, measures the expected loss beyond the value at risk threshold, providing a more comprehensive view of tail risks. We utilize a historical simulation to simulate further returns based on past data, assuming similar patterns will persist. To assess different levels of risk tolerance, we calculated the value risk and expected shortfall at both a 95% and 99% confidence levels. And then finally, we conduct our analysis on a daily basis to capture short-term market fluctuations. Now let's delve into the results of our analysis. So now let's dive into the value at risk and expected shortfall for Robinhood and the sectors of exposure, which in Robinhood's case is made up of securities, crypto, loans, and derivatives. So Robinhood's securities under custody represent the largest segment of their portfolio, valued at $96.3 billion as of June 2024. The value at risk and expected shortfalls for these categories are pivotal for Robinhood's operation. So now let's move into crypto. Robinhood does not engage in the traditional buying and trading of cryptocurrency. Robinhood holds all settled cryptocurrency in custody on behalf of customers in two types of wallets. There is risk associated with holding crypto due to the volatility of the crypto market. Also, technical issues associated with changes and upgrades to the underlying network of supported cryptocurrencies can cause revenues to decline and expose Robinhood to the liability of customer losses. So also, as we move into loans, Robinhood does not engage in traditional commercial or personal lending. Its position as a stock brokerage platform allows users to trade securities, options, and cryptocurrencies. However, their Robinhood Gold service allows for users to engage in margin lending. Margin lending occurs when Robinhood loans users money to purchase additional securities on their app. And then as we get into derivatives, Robinhood does participate in derivatives such as options, and their values are included in the assets under custody report. Their presence is growing in this realm as they report 120% gain year over year for this category. So we took this a step further, and as you can see, we calculated the value at risk and expected shortfall for Robinhood's entire portfolio. We calculated the non-parametric and parametric values, which both offer different perspectives on the potential losses, which allow for a more comprehensive risk assessment. The total value of Robinhood's portfolio is $115 billion, and this analysis is based on the historical price data going back 500 days from September 10th. And as you can see, in this case, a 95% value at risk means there's a 5% chance of the portfolio losing more than the specified amount as you can see, based on our calculations. Now I'll return over to Christian, who will proceed with examining further risk measures as it pertains to Robinhood.
Thank you, Kerry. For Robinhood, risk management is crucial given its exposure to the volatile asset classes that were previously mentioned. This prototype serves as a comprehensive tool to enhance Robinhood's ability to assess portfolio risk. Using 3 years of historical data from CapIQ and Yahoo Finance to calculate VAR and expected shortfall for Robinhood's portfolio, we applied both parametric and non-parametric methods to capture tail risks and estimate potential losses. This process goes beyond basic risk calculations and allowed us to model asset dependencies, simulate market conditions, and measure capital adequacy more accurately. The prototype's key benefits is that it provides actionable insights, enabling Robinhood to make informed decisions, optimize capital reserves, and improve regulatory compliance. By quantifying worst-case scenarios, the model enhances the company's resilience against extreme market fluctuations. To analyze how Robinhood's portfolio would respond under the most adverse conditions, we developed a model that incorporates the worst-case default rate to stress test Robinhood's portfolio. We conducted a sensitivity analysis to understand the impact of extreme scenarios on risk measures such as exposure at default, loss given default, and probability of default. Furthermore, we also factored in the correlation between asset default rates. Based on Robinhood's SEC filings and S&P Global's 2023 research on historical corporate default rates, we derived at a worst-case default rate of approximately 11%. This scenario helps test the portfolio, providing Robinhood with a clear understanding of its risk exposure, especially in the event of widespread defaults across key asset classes like cryptocurrencies and margin loans. This analysis also ensures that Robinhood maintains sufficient capital reserves to absorb potential losses and remain solvent during market downturns. By identifying high-risk exposures, the model helps Robinhood proactively manage risk and maintain resilience during economic downturns. The capital adequacy model we developed follows the Basel II and Basel III frameworks to evaluate Robinhood's ability to absorb losses while remaining solvent. We calculated the risk-weighted assets for Robinhood's portfolio, which includes equities, cryptocurrencies, loans, and derivatives. The capital adequacy ratio we arrived at, of 28.96%, exceeds the minimum regulatory standards for broker-dealers, ensuring financial stability even in stressed conditions. The risk-weighted assets was calculated using conversion factors specific to the risk profile of each asset class. For example, using the IRB approach for the risk-weighted assets provided a more risk-sensitive calculation, while the standardized Basel I approach applied simpler metrics. Using historical data and stress testing techniques, we assessed how different market scenarios, such as a sharp decline in equity or cryptocurrency prices, could impact Robinhood's capital position. This analysis guarantees that Robinhood has enough capital to meet its obligations and mitigate credit risks. Furthermore, by maintaining a strong capital adequacy ratio, Robinhood can continue to operate smoothly even during periods of heightened financial stress, which is crucial for regulatory compliance and investor confidence. This slide covers the integration of machine learning techniques to improve Robinhood's risk management processes. We implemented predictive modeling algorithms such as time series analysis and neural networks, which help forecast future asset prices, interest rates, and other key risk factors. This allows Robinhood to anticipate market fluctuations and adjust its risk exposure accordingly. Additionally, unsupervised learning techniques like clustering and anomaly detection were used to identify unusual patterns in the market, such as fraudulent activity or market manipulation, by identifying unusual trading patterns or outlier transactions. These early warning signals are vital for mitigating risks before they lead to significant financial losses. Machine learning not only enhances the accuracy of risk assessments, but also automates processes, ensuring Robinhood to identify high-risk areas in real time and ensure more efficient decision-making. The Basel III Accord sets global regulatory standards that Robinhood must adhere to, even though it's not a traditional bank. Given its partnerships with financial institutions, Robinhood is required to meet specific compliance standards in areas like capital adequacy, stress testing, and liquidity management. Our compliance plan focuses on operational risk management, ensuring that Robinhood can handle risks related to their third-party services, cybersecurity, and system failures. We also emphasize the importance of maintaining robust capital and liquidity metrics. Through regular stress testing and monitoring of liquidity positions, we ensure that Robinhood is prepared for market disruptions, especially in the volatile cryptocurrency sector. By adhering to Basel III guidelines, Robinhood not only improves its capital resilience, but it also secures its standing with partners and regulators. As a leading fintech platform, Robinhood faces a range of operational risks, particularly in the cybersecurity and data management sectors. With its large user base and involvement in cryptocurrencies, Robinhood is a prime target for phishing attacks, malware, and data breaches. The expansion of Robinhood's crypto offerings further increases its vulnerability as the volatile nature of the crypto market attracts hackers. Furthermore, Robinhood relies on external vendors such as Amazon Web Services for cloud storage, as well as Venmo, Chase, and Rocket Money for payment processing. These things make it susceptible to infrastructure outages and third-party risks, which are crucial to mitigate. Any disruptions in these services could cause significant financial losses and damage to the platform's reputation. To mitigate these risks, Robinhood needs to strengthen its cybersecurity infrastructure, monitor third-party vendor performance, as well as implement regular system audits to ensure operational integrity. To mitigate Robinhood's operational risks, we propose several targeted strategies, starting with empowering its leadership, particularly with their chief risk officer, to build a culture of compliance. We recommend conducting operational risk tests that simulate cyber attacks, payment failures, and system outages to ensure that Robinhood can recover their critical services in these scenarios. AI-driven monitoring systems are crucial for detecting irregularities such as unusual traffic patterns or breaches that could go otherwise unnoticed. Furthermore, implementing regular audits of third-party vendors, particularly those handling payment processing and cloud services, will help ensure compliance with industry standards such as the payment card industry data security standards. These strategies, along with enhanced internal audits and continuous system testing, will improve Robinhood's ability to manage operational risks and protect its infrastructure from disruptions. Managing liquidity in a volatile market like the cryptocurrency market poses significant challenges. Cryptocurrencies such as Bitcoin and Ethereum are highly volatile, and liquidity can fluctuate rapidly, especially during weekends or holidays when trading volumes are lower. To address these challenges, we recommend that Robinhood adopt key Basel III standards, including the liquidity coverage ratio and net stable funding ratio. These ratios ensure that Robinhood maintains sufficient high-quality liquid assets to cover their short-term obligations during stress periods. Furthermore, Robinhood should diversify its liquidity sources to reduce reliance on a few exchanges, thereby lowering counterparty risk. Stress testing liquidity positions during adverse market conditions will help Robinhood prepare for liquidity crises and ensure that it can meet all trading demands at all times. The liquidity management framework we propose focuses on real-time liquidity monitoring and stress testing to handle the challenges presented by the volatile cryptocurrency market. By aligning with Basel III guidelines, particularly the LCR ratio and the NSFR ratio, Robinhood can ensure that it holds enough high-quality liquid assets to cover outflows during periods of market downturn. This framework also includes the use of automated market-making protocols and smart contracts to streamline liquidity management. The primary goal is to ensure that Robinhood can meet both short and long-term liquidity needs while mitigating risks related to sudden market fluctuations. Implementing the real-time liquidity monitoring systems will further enhance Robinhood's ability to react swiftly to changes in the market, maintaining stability even in extreme conditions.
Thank you, Christian. Our analysis has provided a detailed overview of Robinhood's risk exposure. We've segmented securities, cryptocurrencies, loans, and derivatives. We utilize both VAR and expected shortfall metrics to quantify potential losses under different levels, focusing on short-term fluctuations. In particular, Robinhood's securities portfolio, valued at $96.3 billion, represents the highest exposure. This highlights the importance of understanding the worst-case scenarios in market downturns. where estimated shortfall plays a critical role. For cryptocurrencies, the exposure is smaller in dollar terms, but the volatility introduces significant tail risks and kurtosis. In the case of loans, Robinhood's margin lending introduces specific risks, primarily driven by market movements and customer defaults. These insights provide strategic direction for enhancing Robinhood's risk resilience. Future actions should emphasize stronger controls on cryptocurrency markets and more robust margin lending process. This helps the company better navigate potential market instability. This leads us to capital adequacy measures for Robinhood. In other words, its ability to absorb losses without becoming insolvent. This is crucial for Robinhood, who operates as a brokerage not only to protect the firm, but to protect customer funds. To determine if Robinhood has sufficient capital, we calculated the risk-weighted value of its assets based on their perceived riskiness. Robinhood's RWA was 12.5%. We then calculated Robinhood's capital adequacy ratio by dividing the total capital and the subordinated debt by its risk-weighted averages. In Robinhood's case, they have about 28.96%. This is more than adequate given that it meets the minimum capital requirements for broker-dealers as set by the Financial Industries Regulatory Authority. This states the capital must not be less or greater than $250,000 or 2% of its aggregate debit items. Robinhood is in great shape with their capital adequacy. Despite being well positioned with their capital, Robinhood as a brokerage faces key factors that can affect their capital adequacy. Market volatility and fluctuations in market prices can impact their bottom line, as losses on customer positions can reduce its capital base. There's credit risk as well. If Robinhood extends credit to customers, it is exposed to credit risk, which can impact its capital adequacy. And there's also operational risks such as system failures, fraud, and even natural disasters and events that can affect their infrastructure. Also, there are regulatory changes that need to be considered. Changes in regulatory requirements, such as Basel III, can affect the amount of capital Robinhood is required to hold as well. Assessing credit risk is essential for understanding the potential losses associated with Robinhood's target markets. Robinhood has a diverse range of customers, and their target market includes retail investors, options traders, and cryptocurrency investors. The growing popularity of commission-free trading and increased interest in alternative investments make this market very attractive for Robinhood. To better understand Robinhood's risk exposure, we obtain the historical behavior of corporate default rates, which we use to create our credit risk model. The provided data shows cumulative default rates for speculative-grade corporate bonds across various time horizons from 1981 to 2007. We'll see an increased default rate over time. As the time horizon increases, the cumulative default rate generally rises as well. This indicates that the likelihood of a corporate bond defaulting increases with time. While overall the trend is upward, there are significant variations in default rates from year to year, reflecting economic conditions, industry-specific factors, and other outside influences. Default rates tend to be higher during economic downturns and recessions, and lower during periods of economic expansion. While the data does not show individual credit ratings, it's generally expected that lower-rated bonds have higher default rates than higher-rated bonds. So the implication for investors is the risk-return trade-off. Investors see higher returns from speculative-grade bonds, and they should be aware of the associated higher risk. And the mitigating factor here is diversifying investments across different sectors, and this can help us diversify and mitigate our risks. Understanding the economic conditions and industry trends can aid in assessing the likelihood of defaults with Robinhood as well. To further assess Robinhood's credit risk, we calculated several key metrics using the cumulative default rates previously shown. We needed to calculate the survival function representing the probability that a customer will not default at any given time. we needed to calculate the default density. This is the instantaneous probability of default at any given time t. The hazard rate, or the lambda as well, is a conditional probability of default given the customer hasn't defaulted up to that point. With these metrics, we determined the PD, or the probability of default, which was key to calculating Robinhood's WCDR. So we present two key plots. The cumulative hazard rate on the left, showing the probability of a customer default, increases over time, much like the corporate bond spreads that we just analyzed, as well as the cumulative WCDR, illustrating how this evolves is influenced by Robinhood's customer base composition. Some of these key observations include the cumulative hazard rate generally increases over time. The WCDR follows a similar pattern to the hazard rate, though it can vary depending on the risk profile of Robinhood's customer base, with the higher risk customers elevating the WCDR. So the implications of this are fourfold. In the risk management, the model helps us quantify the default likelihood crucial for managing risk and allocating resources effectively for the firm. It also helps in capital allocation. The WCDR informs Robinhood's economic capital needs and enables efficient capital allocation across customer segments. It also informs pricing. By understanding the credit risk, Robinhood can adjust product pricing, ensuring it's compensated for the associated risks. And overall risk mitigation. The model allows for the identification of high-risk customer segments and be proactive in risk management strategies, such as tightening margin requirements. Overall, this framework equips Robinhood with the tools to monitor, assess, and mitigate credit risk, driving more informed decision-making and resource allocation. As we've discussed throughout our course, macro factors can change, economic conditions can change, and even internal factors within a firm can change. And this brings us to model validation and calibration. It's important that we backtest and stress test our models to ensure that they're optimally functioning and reflecting risks in an accurate way. To that end, we introduce a stress test impact, and the blue bars show a higher cumulative default rate compared to the WCDR, indicating that the stress test scenarios result in significant higher likelihood of default. The time horizon of the cumulative default rates increase over time for both scenarios, reflecting the growing risk of default as the time horizon extends. The blue bars generally follow the same upward trend of the curve, but with a steeper slope suggesting a more pronounced impact of the stress test. Overall, the implications of the risk analysis highlights the potential impact of stress test scenarios on default rates. And we also look at capital allocation, as the WCDR can be used to allocate economic capital to cover potential losses under both normal and stress conditions. Overall, validating and calibrating our model will lead to better risk mitigation, where the results can inform our strategies for mitigating credit risks, such as diversifying the portfolio or increasing our capital requirements at any given time. In conclusion, our group would like to provide a brief overview of our key findings. Our analysis has provided a detailed overview of Robinhood's risk exposure, segmented by securities, cryptocurrencies, loans, and derivatives. We utilize both VAR and expected shortfall metrics to quantify potential losses under different confidence levels, focusing on short-term fluctuations. In particular, Robinhood securities portfolio, valued at $96.3 billion, represents the highest exposure. This showcases the importance of understanding the worst-case scenarios and market downturns, where ES plays a critical role. For cryptocurrencies, while the exposure is smaller in dollar terms, the volatility introduces significant tail risk. In the case of loans for Robinhood's margin lending, it introduces specific risk primarily driven by market movements and customer defaults. These insights provide strategic direction for enhancing Robinhood's risk resilience. Future action should emphasize stronger controls in cryptocurrency markets and a more robust margin and lending policies. This will help the company better navigate potential market instability for the road ahead. Please check out our resources page, and we thank you for your time.